The coronavirus pandemic has indeed taken a toll on the global economy, including the stock exchange market, when the government of different countries started imposing lockdowns to curtail the spread of the virus. There were predictions that COVID-19 would end a bull market in technology that had lasted more than a decade. About 6 months after the World Health Organization declared the coronavirus a worldwide pandemic, tech stocks have bounced back. Investors now pour money into technology companies like Microsoft, Apple, Facebook, Netflix, Amazon, Zoom, and Google, because of booming demand for their services due to millions of people spending more and more time online because of COVID-19 lockdowns. As of late July, these companies returned 35% YTD, while the remaining 495 stocks in the S&P 500 index struggled to return -5%. In this episode, we would be highlighting some of the reasons that made tech stocks boom in 2020. Adoption of technology rising fast. While the rest of the economy is tanking from the crippling impact of the coronavirus, business at the biggest technology companies is holding steady, even thriving due to the adoption of technology for everything. From online shopping, accounting, all the way through to video conferencing and video streaming, the list is endless. With people told to work from home and stay away from others, the pandemic has deepened reliances on services from the technology industry's biggest companies, while accelerating trends that were already benefiting them. For instance, recently, Amazon said it was hiring 100,000 warehouse workers to meet surging demand. Mark Zuckerberg, Facebook's chief executive, said traffic for video calling and messaging had exploded. Microsoft said the numbers using its software for online collaboration had climbed nearly 40% in a week. Amazon had muscled in on retail businesses for years, but now shoppers are turning to the e-commerce giant for a wider variety of goods, like groceries and over-the-counter drugs. Streaming services like Netflix have dampened box office sales for movies in recent years. Now, as movie theaters close under government orders, Netflix and YouTube are gaining a new audience. Old school companies fall by the wayside. COVID-19 has been a disaster for old school companies over the last few months. But right now, it's hard to measure exactly how much of an impact the global pandemic has had on the sector. There have been widespread closures of department stores around the world since January 2020. At the height of global lockdowns, the pandemic widened the gap between old school companies and online businesses as consumers were pushed fully online. Interstate and international travels were completely brought to its knees. The old model of traveling and lodging in hotels to attend meetings became unattractive. Even the tourism sector was not spared, as the sector is unlikely to return to its old pattern. Global tech stocks pushing the entire market higher. Global tech stocks are pushing the entire stock market higher. For instance, in late March, the market capitalization of technology-specific Nasdaq climbed by over 56%. In fact, stocks grouped into FANG, which includes Facebook, Apple, Amazon, Netflix, Google, and other tech giants like Tesla, surged by over 83% in the wake of the pandemic. These occurrences are not a hot trend. Even if the rise in tech stocks cannot all be immediately justified, genuine wealth has been generated by these tech giants. Profits changing fast. According to a report posted by McKinsey, a global management consultancy company, profits are fast changing alongside the perception of investors. The report clearly asserted that sectors that started strong on the stock market, like semiconductors and pharmaceuticals, before the coronavirus pandemic are proving to be resilient. But those at the bottom of the index, like utilities and banks, are suffering the biggest losses. In fact, the 6 companies at the bottom of the index have lost more than $373 billion, while the 6 most profitable have gained more than $275 billion. Scalability gives tech companies a big advantage. With competitive advantage and market shares at stake, scalability is a key driver for growth in high-tech companies. Ever-increasing demand and emerging technologies drive the need for innovation at scale. A piece of software costs the same amount whether it's produced for one person or 50 million people. Tech companies are catching in on this fact to blossom compared to their brick-and-mortar companies. Revenue per employee shows the potential. The revenue generated by employees of these tech companies also contributed to making tech stocks boom. For instance, during the crisis, $2.7 million was generated per employee at Apple, Facebook $2.2 million, Google owner Alphabet $1.9 million, and eBay $1.1 million. As of today, these figures would have increased since the pandemic doesn't have a cure yet. Central banks also pushing stock prices higher. Trade these days is simple. Just follow what the central banks around the world say and you're pretty much guaranteed to make money from growth companies. As long as they announce they're printing more paper or lowering interest rates, then just buy tech stocks. This requires no thinking whatsoever, and the fundamentals like economic data and corporate earnings don't really matter. Central banks are the only force driving the key stock indices higher. In the US, stocks jumped after central banks deployed a flurry of emergency measures to try to buffer the global economy from fallout stemming from the coronavirus pandemic. The S&P 500 advanced 1.7% and the Nasdaq Composite gained 3.4%, boosted by a rally in shares of technology companies. Due to the high scalability of tech companies' business models, they have an inbuilt advantage in this environment compared to traditional companies that only generate profits from fixed assets. That's it for this episode. If you found the information here useful, hit that like button. And if you want to support us even more, buy us a coffee from the link in the description. If you'd like to see more episodes on financial advice, hit that subscribe button and turn on the notifications for our latest updates. Good luck and see you in the next episode.